All right, all right. How's everybody doing tonight? Everybody got pizza? Everybody? Good, good, good. Okay, so we're going to start getting this started. Welcome to our third meeting. We got a lot planned for you today. We're going to have our presentations and such. So, sweet, let's get it started. All right, guys, here's our meeting agenda today. Of course, we have our three presentations, and then we have our sweet spot, and then we have society updates afterwards. All right, we'll start with our outperforming moments. Does anybody have any outperforming moments that they'd like to share with us today? Anna, nice, an interview. All right, round of applause. Jair? Perfect. Yeah, interview set up. Perfect. Round of applause. Fantastic. We'll stop it there. Gotcha. So now I have my quote of the day today for y'all. And I got this from a book I read, and it's not your attendance that matters, it's your attention. And I think this transcends school. Obviously, you should attend your classes and pay attention and actually absorb the material. But being present in the moment, whether it's a family dinner or whatever it is, actually being there mentally is what's important. So I just want to share that one with y'all. Now make sure to sign in today. This is how you can enter for that raffle for the $25. So pull out your cameras, scan that. We lost that one, but thumbs up whenever you're done. So up first, we have the market outlook with Juan Carlos. You ready, Juan Carlos? Round of applause.
All right, wish me luck, guys. So let's start off with the S&P 500 market. So with the CPI, which is the consumer pricing index, it increased 0.5% month to month. So from January to February. So what this adds to the S&P 500 is it adds uncertainty. You know, with things being more pricey, it could change your costs, growth, revenue growth, net profit growth, raw materials as well. It could raise product prices, which we'll see later in my presentation. I actually have inputted Coca-Cola. And the S&P 500 closed yesterday when the CPI came out at 4,136 points, only a small little decrease of 0.03%, which is not really much considering the CPI came out, which is supposed to really lower the S&P 500. And you would assume that it would go lower today, right? It actually went up today, 0.28%, closing at 4,147 points. Then we move on to the 10-year Treasury, which is the Fed increasing rates. They increased the rates by 0.25%. I believe it was last week or 2 weeks ago. And that closed at 3.8 points, closing at increase of 4 basis points. That was yesterday. And then today, it closed at an increase of 4.8 basis points to 3.8 points. Now we have Airbnb. Did y'all go out anywhere, order Airbnb during the winter break or something like that? Maybe even Thanksgiving? I know I did. I went to the island, South Padre Island. So Airbnb released earnings yesterday. They released earnings yesterday, and it shot up the Airbnb stock price to $120, increase of $4.4. And this is pretty good. They beat revenue expectations. They beat all of their expectations for the most part. Their actual revenue was 1.9 billion when they expected 1.82 billion. So I know me as an investor, or all of us as investors, beating something that was greater than expected, that's a very good sign. It's like if I expected a 70 in the test and I ended up acing it with like a 95. And now against inflation, with the market and inflation going up, and rates as well going up, you expect the entire markets are many stocks going down. We actually have Airbnb going up, as we saw yesterday with their earnings report. And today, I wish I put money in to Airbnb. You had an increase of 13.35%, closing at $137. And here we have a comparison of Airbnb from the beginning of the year to the market as well. So the market is the S&P 500 in orange here in the bottom line, and we have the Airbnb just moving up. And they actually had their best year was 2022. So you can imagine they're doing pretty good. Now we have Coca-Cola. So we saw Airbnb actually going against the market of what the feds are expecting the markets to move, which is up. Now we have Coca-Cola that could have some problems on its way. I don't know if y'all have seen. I have not seen a 24 pack of Coke. I only see 20 packs. I'm bummed out. And we have the increased prices. So they're really feeling the inflation. And the rest of the market isn't feeling it too well, but the goods are actually feeling it first, which makes up 25% of the market. And with this, we have increased prices for materials with Coca-Cola. They also decreased, like I mentioned before, 24 packs to 20 pack. How many items they can hold and sell off. And we have not too good for Coca-Cola. Again, we have retail sales that have increased by 3%. We had expected 1.9%. So retail sales, basically how many new retail sales have we've been actually like spending out, buying as consumers. So this can be either by holiday shopping, and people just don't care about inflation. I know I kind of didn't care about inflation. You know, I still bought clothes, stuff for my parents and my sisters. And then we have a quote here by Jerome Powell. Shows you why we think disinflation will be a process that takes a significant period of time. So we didn't see it with Airbnb as well as other stocks, but we did see with Coca-Cola. I believe Pepsi was still doing all right. Coca-Cola stayed on the $60 closing price, but they are feeling the inflation a lot more by possibly in the future lowering their revenues with the increase of price they're gonna have to put on Coca-Cola. Here we actually see a comparison of Coca-Cola and Pepsi. You can see they're for 1 year. You can see they're pretty much moving pretty close. And then towards the end right here, I believe they're moving down and then just slight little spike up. Now we have Alex with economic perspective.
Yeah, that's a great presentation by Juan Carlos. I just want to give you guys a quick reminder that we do have pizza. If you guys want to finish that off, I'm going to creep down real quick, help yourself. But up next, we do have Alex.
Alrighty, guys, get the economy part now. Very exciting part. So we're going to start with a little bit of monetary policy, kind of to add on my last week's presentation a little bit. It's going to take not too long, and then go into the federal funds rate and then into the CPI. So the expansionary monetary policy, monetary policy is kind of what the Fed conducts, right? They can either go into this expansionary monetary policy or contractionary monetary policy, and that is kind of they're the opposites of each other. So if the Fed engages in an expansionary monetary policy, they're trying to stimulate growth in the economy, right? So they're trying to speed up the economy and increase economic growth, and they do that by buying bonds, like I said last week. And when they buy bonds, they increase the money supply. And when they increase the money supply, that decreases the interest rates. And so on the contrary, we have contractionary monetary policy, which is aimed at slowing down the economy because the economy might be overheating, and we need to slow it down, which is what's going on right now, right? So the Fed's engaging in the contractionary monetary policy. They're selling their bonds or letting those bonds roll off, and so that's decreasing the amount of money the money supply, so the amount of money in the market, that increases the interest rates. The FOMC, which is the Federal Open Market Committee, they move the federal funds rate, the range, and so the current federal funds rate is at 4.5 to 4.75% as of February, so it's this month, and that was an increase by 25 basis points. So they kind of slowed down their rate increases from 75 and 50 previously. So now they're at this 25, and their projections are that they want to reach 5 to 5.5% in 2023, and they want to begin lowering that in 2024, and then reach 2.5% in 2025. And as we'll get in later, this is kind of we can start to think about this later on with CPI and what that means, right? Will the Fed have to go beyond their projections of 5.5% because of inflation and because of the labor market? So we're gonna look at that into the next slides, and I want you guys to keep that in mind to see, what is going on in the market and see what you guys think. So here's January CPI. We got in a little slightly higher than expected. Right, so the CPI month to month came in at expectation. So this is kind of confusing, so I'm going to read it out line by line. CPI month to month came in at 0.5% versus a 0.5% expected. And then we had core CPI, which strips out food and energy. They're the volatile aspects of CPI. And that came in at 0.4% versus 0.4% expected. And you had CPI year over year, which came in at 6.4% versus 6.2% expected. And then versus a 6.5% previous. So that's where that and core CPI year over year, 5.6% and versus 5.5% expected is kind of where, the markets did not like it as much, right? Because CPI came in above expectations, which means that CPI may be more sticky than expected. It also came in only 0.1% lower than previously. So that indicates a more sticky CPI that investors don't want to see, right? If CPI is stickier, then interest rates are likely going to go higher, right? One CPI report doesn't tell you everything. So if we look at next month's, I'll talk about that as well. If CPI comes in next month, let's say at 6.2, 6.3, it's staying there, it's sticky. Then this might cause the Fed to increase their interest rates, beyond what they expected. So maybe go past 5.5%. And so this is the chart, right? You see the dark blue line is at 6.4%, which is the CPI, and then the core CPI, which is at 5.6%. You can see, how it's changed since 2020. There's this other, I don't have it here. There's this other new measure that they're doing. It's called super core. So that's taking out shelter, right? So the Fed is starting to look at this super core one instead of the core CPI, which they looked at before. And the super core strips out shelter because shelter recently has been kind of this volatile because shelter, the cost to build shelter, also rents have been increasing pretty dramatically. So they're looking at this new measurement. And so the market reaction, like Juan Carlos said, S&P fell, I think, about a percentage, right at the news. So that's to be expected. But then started to go back up towards the end of the day. The Nasdaq fell even more and stayed down even further. And so that's kind of given, right? So to realize like the intuition behind why the Nasdaq will fall even further than the S&P is because the Nasdaq is a technology company. It's technology based, right? So those are all technology companies. And when you're in a tech company, investors expect high growth. And when you're a high growth company, you usually seek out more debt. And when you seek out more debt, that gets affected by interest rates. And so if you have a CPI that comes in higher than expected, investors start to perceive that inflation or interest rates will go higher than expected. And so if interest rates go higher, then the debt expense on these companies will increase, and that's going to affect their bottom line. And so that's why the Nasdaq is going to get more affected by higher interest rates or these changes in interest rates, right? And then this is not too important, but still interesting to know. And the 6-month U.S. Treasury yield reached above 5.5% since 2007. We'll go into a deep dive into the consumer price index. So we see that if we look on the right, the graph on the right, month to month, you see all items is 0.5%. We had food coming at 0.5%, energy at 2%, and gasoline at 2.4%. So that was the main driver, just gasoline. One of the main drivers. The other main driver was actually shelter. That contributed to 50% of the monthly increase. So that's why as you can see, that the Fed is starting to look at that super core measurement, which is stripping out shelter because shelter is playing a huge role in inflation right now. And so you see that the new vehicles kind of went up barely. Used cars and trucks went pretty back down, right? Negative 1.9%, which is a good sight because those were very overvalued. And you have apparel going up at 0.8%, shelter at 0.7. You see that shelter was at 0.7, but at 2.4, and gasoline was at 2.4%. And I said that shelter attributed to 50% of the monthly increase. And that's because shelter, like in the CPI, each category is given a weighting. The shelter is given a higher percentage of weighting in CPI, and that's why it contributes a lot to the changes in CPI. And so we have transportation services coming at 0.9%, and the medical care services came in at negative 0.7%. The year over year, as you can see that the transportation services is the highest at 14.6%. Food is also high at 2.1%. And as you can see, egg prices rose 8.5% this month, and they're up 70% in the past year. Right? That's crazy. I went to the grocery store the other day and I realized that my eggs were $10. So that's pretty expensive. And then a week later they were $8. So I was like, that's a 20% decrease in the price. I don't know what's going on. So CPI is definitely a big factor in the Fed's decisions to increase interest rates. And then we also saw the labor market. The labor market is also another big factor in the unemployment rate coming in at 3.4%, which is leading to this kind of stickier inflation because the labor market is so tight, right? People still have jobs and they're willing to spend in this high inflationary environment. So here I'm going to ask you, if you guys have any questions right now, or questions that you don't want to ask maybe in public, or any ideas that you want me to talk about in the future, you guys can scan this. Well, yeah, they are honest. This is all on the BLS. You can find all the information of the movements of eggs, of the movements of food, month over month and year over year. The stripping out, going to core CPI and super core CPI, is just to see how everyday items or less volatile items are moving, right? Because if the core CPI strips out food and energy, and as you know, food and energy can be very volatile because of supply chain issues or other things. And then gas can be very volatile because, as you saw, Ukraine that made it very volatile. And so that's why they strip out those things, because it adds a lot more to CPI usually, right? So they stripped it out to figure out what it is if it wasn't so volatile. Any other questions anyone has? Everyone's good for today. Cool. You guys can connect with me on LinkedIn, Anatomy. If you guys have any questions too, you guys can come up after the meeting and we can chat a bit.
That was a great presentation from Alex. And I want to give him a quick shout out. He actually has the Society of Economics 5:30s every other Monday. The discussions in there are awesome, super active, super great. All right. So we started the meeting talking about the overview of the markets, and then we just concluded talking about the overview of the economy. Up next, we have Brian. He's going to give us a specific case study here with mergers and acquisitions. So Brian.
Hey guys. All right. So today I'm going to talk about the merger and acquisition between T-Mobile and Sprint. All right. So it's an all-stock merger at fixed exchange rate ratio of 0.1026 T-Mobile share for each Sprint share, which means that for every 9 share of Sprint, you get 1 share of T-Mobile. And in the announcement, the enterprise value of Sprint was $59 billion, and the combined company was $146 billion. So they decide, as in agreement, they decide the combined company's name is going to remain as T-Mobile, with the expected run rate cost synergy of more than $6 billion, which means that the run rate cost is going to save at least $6 billion after this deal. With the net present value means that the value you get from an investment, which is worth at least $43 billion. And as you can see right here, the announcement of this is all the way back from April 29, 2018, but it's not completed until April 1st, 2020. This say a lot about merger and acquisition because it takes a long time to go through a deal like this. And to be honest, as an investment bankers, they even have to analyze about the deal way earlier than this. And this is such a big deal because the transaction value was $68 billion with the equity value of $27 billion and the net debt $41 billion. And since it's not a hostile takeover or anything like that, the two companies come to an agreement which leads to a friendly natural fit. And as you can see, the CEO must be happy, like the Obama, he got 2 phones. And why they go through this deal? As I told you guys last week, there are many reasons for them to go through merger and acquisition, but one of the most important reasons why T-Mobile acquired or do a merger with Sprint because of their spectrum, their mid-band spectrum. While Sprint have a mid-band spectrum of 2,500 megahertz, T-Mobile only hold around 700 megahertz. And with the rapid growth in subscription for T-Mobile, they don't have the network capacity to provide, to give the demand. That's why the Sprint have the resource that they need to achieve their ambition, which is lead to the 5G. And since T-Mobile and Sprint has very similar in DNA in the operation, which leads to efficient and lower cost in operation and greater economies of scale. They also would provide with better resource and better quality. And as you know, there are 4 main, in the telecommunication industry, there are 4 main companies, right? Sprint, AT&T, T-Mobile, and Verizon. Yes, I almost forgot. And as a result, and you know how Verizon has been a king of 4G for a while, and they have a lot of customer and users still, 4G still. And so the transition to the 5G gonna take slower for them, while Sprint and T-Mobile is already on the move to dominate the market, the next market. And yeah, if the merger and acquisition go through, and as we already know, T-Mobile is very big on 5G right now. And this merger and acquisition also create more jobs for the economy. Pro forma. Pro forma is just basically a financial statement that predict the future period. So this pro forma was made in 2018 with a service revenue of $53 to $57 billion and adjusted EBITDA of $22 to $23 billion. Adjusted EBITDA margin of around 41% with a longer term target of 54 to 57%. The net debt of this is 63 to 65 billions with streamlined single silo corporate debt structure. And of course, after the merger, is a fully funded business plan with significant liquidity at close. Oops. Oh yeah, and so I pulled out some data for you so you can see how this merger and acquisition actually helped T-Mobile a lot. As you can see, of course, the deal was announced in 2018, but it didn't get completed until 2020. And you can see the revenue remained pretty much the same in 2019 with $44 billion, but then it increased significantly over the year 2020 and 2021. And of course, it's not doing too bad in 2022. And for the EBITDA, adjusted EBITDA, you can also see the significant increase they have over the year. But of course, it looked very low in 2022. That's why we account for revenue and EBITDA, because you need to know the earning before the tax and interest. And this also shows the graph of the timeline, the merger and acquisition from 2018 to 2020. You see at the proposal, it was increased a little bit because I guess people get excited for it. But then during the announcement, it go down. Maybe because of uncertainty, they don't know if the deal gonna go through or not. But of course, it hit the highest point in this timeline at the amendment. And yeah, of course, we cannot forget to give the credits for all the people who are involved in these deals. As you know, like in the corporate world, everything are connected, and there are a lot of parties that involved in this transaction, including financial advisors for both sides, the legal side, the lawyers, and of course, they also, since the move that they make is very significant for the industry because it's not just a new technology, the new type of network, 5G, but it's also, they might be feared that they create monopoly out of this, in this industry. So they need to go through the approval from FCC, Justice Department, Public Service Commission. And over there, for any of you who dream of working in investment bank, this might be a good number to look at because after this deal, T-Mobile and Sprint split the fee of at least $155 million for the pension, for the investment banking. And of course, as the analyst or associate, you get the bonus based on the deal you make. And that's pretty much it. You can connect with me on LinkedIn.
Awesome. Thank you so much, Brian. So that concludes our 3 student-led presentations for today. And up next, we have the sweet spot with Professor Sweet.
All right, so we're still finalizing the classes. I'm hoping to finalize it tomorrow and Thursday, which is tomorrow. So we'll hopefully have something out this weekend. We have about 8 or 9 classes, so it's be pretty good. Someone was asking me, one of the classes someone wanted to teach, I thought was pretty cool, is to learn Bloomberg portfolio. Some of y'all have been asking, how do you actually invest? How do you get a portfolio? So we're going to try to get that class. I haven't used Bloomberg portfolio in a while, so I have to relearn it because they've changed it. That'd be pretty cool, but we got some others lined up. What I want to do tonight is talk 2 things that I think are interesting at the beginning of the year. So there are certain things, certain sayings that you hear in investing, and every time I hear them, I always want to go test them and see if they're actually correct. So one thing you hear a lot is, as January goes, so goes the whole year for stocks. So I was kind of curious if that was true. So I went back and I pulled January for every year. There's January. And then I pulled February through December, and then the entire year. So you look at some famous years like 87. January is up 13%, but the rest of the year is down 10. Did y'all know that in 1987 the stock market had a positive return? Anybody know that? You know about Black Monday in 1987, right? The market fell 23%, but you know the market was up for that year. Pretty amazing, isn't it? What about 2008? That one looked like it worked out pretty well. January's down 6% and the market was down 34% the rest of the year, which I remember that very well. That was my last year before I retired. Picked a good year to retire. The next year though, January's down 8%. So when did the market bottom in 2009? Anybody know? Sometime in February, wasn't it? So there, the market's down 8%, but it actually recovered 35%. 2010, it was down, it came up 17. Does it look like January is a good predictor? It's not too strong, is it? The correlation to January to the year is 0.53. That sounds reasonable, but then January's in the entire year. So you think that would have some influence. So we don't want to compare January to the year. We want to compare January to what? February through December. And there the correlation is 0.25. So it is positive. So there is a positive relationship between January and February, December, but y'all know the difference between correlation and R squared. So, what did I just do? Whoa. Sorry about that. The arrow key is the delete key is where the arrow key is supposed to be. So I'm hitting delete instead of arrow. Okay. So correlation squared is R squared because correlation is rho and rho is R. So rho squared is R squared. January only explains 6% of the volatility of the rest of the year. So it's not the greatest predictor out there. It's not even all that strong. But why is January important? So January is unique. And so what's really critical about January? Well, it follows December. You probably think that's kind of obvious. What happens in December? What is everybody thinking about in December? Well, holiday spending, but even more from an investment standpoint. What happens April 15th? The stuff you did in December, you're right. You got tax planning. Did you say that, Waylon? I just didn't hear you. So tax planning. So what happens in December is people are, if they have losses, they want to sell stuff, so they have losses to get. If they have gains, they probably don't want to sell, and they'll probably wait till January. So there is a tax impact, especially between large and small cap stock. There's a lot of things. People think there's window dressing. You don't know what that is. So in December, if it's a really strong year, what they'll do is they'll buy the big names like Apple or whoever's up a bunch. They'll have those and make sure they're in their portfolio because December is important. So what I'll make sure those are in their portfolio for December when they send out the report to their customers. They can say, see, we had the big stocks. And then in January, they sell those and go buy the ones they wanted. So that's why there's kind of somewhat of a big cap, small cap hit, but there's also the tax impact. But you can see it's not something that's really predictable. So maybe what I should have done is looked at how does the prior year influence January, because then the tax, because people do different things when they have tax gains than when they have tax losses, and you have to generate sales. So it's not a strong relationship, but there is some truth to that story. I did the regression, and if the regression had any significance to it, then it would predict that the rest of the year would be about up 11%. I don't know what's February done so far. Has it been generally negative? So it's like not too sure what February is. The other thing people ask is the presidential cycle. So there's 2020, or the first, that's 2021, that's the first year. 2022, where are we today? The third year of the presidential cycle. So historically, this is the year to be in stocks. It doesn't just outperform, but it significantly outperforms the other years. You can see the first year, so 2021, usually up about 3%. Second year, about 4%. Fourth year, about 7%. Third year, up over 14%. In fact, it's the bulk of the history. But what's the problem with this? So I strongly recommend, I've been a big promoter of GMO, gmo.com. Get registered for their site and read their writing. They're real big on a couple of things. One thing is on the presidential cycle. They've written a lot about that. The other thing they write about that is really, I think you should all be reading up on, is historical bubbles. They're the bubble people. They have all the bubbles documented. They're predicting a bubble right now. They think the stock market's going to sell off quite dramatically. But they go back and look at all previous bubbles and talk about them. And so really, really good site. But what they said about the presidential cycle is that it was incredibly, and they used to promote it. They used to say the presidential cycle is very predictable, and they would give, and you always have to have a reason why, right? If you find a relationship, you got to say, why is that? And their argument was the election cycle. The third year is when Congress goes wild and starts spending because they got an election next year. And they tend to bump up the economy and cause wild things to happen. And that's why that third year is so important. You don't do it in the election year because that looks too fake. You got to do it the year before because you got to have time for it to work. Then when you go to the election, you can say, look at what I did for you, which I never like that. I never like it when someone says, look what I did for you with someone else's money. I wish they'd always say that, don't you? Look what I did with somebody else's money for you. They didn't do anything for you because it's not their money, but they still like to do that in elections. Since 2008, that entire process has completely disappeared. You can see the relationship's not even close. The first year is the highest. The second year is negative. The third year is like the third best. It's no longer the best. Now, why is that? So GMO talks about the presidential cycle fell apart in 2008, had nothing to do with President Obama, though it coincided, but it really had to do with the financial crisis and the Fed's response to the financial crisis, and that the Fed is now driving stock markets more than fiscal spending. And that's still going on this year. So fiscal spending, you know, we got a debt ceiling. How's that going to get resolved? Well, you can probably tell us. The debt ceiling, is that still a problem? When does she run out of money? July. So in July, so that's going to cause some problems. Obviously, they're going to fix it somehow. Plus, they spent a lot of money last year, didn't they? That IRA or whatever, IRS, what was it? Inflation Recovery, IRA, that was a lot of money. Can they really spend that much more money again this year? So I don't think it's all that predictable, but it's good to know these type of cycles. What other things are there out there like that? The other one you hear is sell in May, go away. Does that work? I might look at that one of these times. Have y'all heard that one before? Sell in May and go away. That's the tough one, because when in May do you sell? May 1st, May 31st, April 30th? It says sell in May, so it must be at least May 1st. And then when do you come back? In June, July, August, September, October. So that one's a tough one. I've heard people have tried to test that one out. But these type of rules of thumb, you hear them. So what I would used to do on my job, anytime I would see those, we would just go and run the numbers immediately and see, is there something there? And then if there's something there, you got to ask, is there a reason? It's got to be a reason, because there's a lot of just random noise. Like if the NFC wins the Super Bowl, the stock market would do well. Who won the Super Bowl? Kansas. That's NFC, right? No, AFC. Oh, that's bad for stocks. So we got one for stocks. It's a January effect. That's positive. The presidential cycle, that's positive for stocks, but it's not working anymore. And then the AFC won, so that's negative for stocks. But can you think of a rational reason why AFC winning would make the stock market? Some people say, well, how many New York teams are there and the difference? And if New York wins the Super Bowl, you got a bunch of New York analysts be happy, and that's stock. But that's a stretch, isn't it? The presidential cycle, you can make an argument because of what Congress does for elections. The January effect, you can make an argument because of the tax windows. But those two don't look all that strong, especially going forward. And so you're looking for those relationships. So what I would encourage you to do, and if some of you want to come down to FSC, I can show you how I do it. What I encourage you to do is create dashboards and start monitoring the key markets. And what I like to do more than anything else is has a dashboard to try to see, is there one market that's behaving incredibly abnormally? Is there one market that's different than it should be versus its history? Whether it's, its relative values, whether it's its trend, how it does, growth stocks versus value with the Fed raising rates, those kind of things. Trying to find some argument for why you want to be in one place versus another. Because when you get in an interview, they may ask you what ideas do you have. And you want to have an idea that's first you thought through it. And I think even more important, this sounds crazy, but you need an idea that's really weird. You need something that a normal person wouldn't. I mean, you want to be somewhat normal. You don't want to scare them too much. But you want an idea that's a little bit out there. And so that's why you need to experiment with these type of things. You're trying to find something that when you say it, they go, you want them to do that. What did you say? Like they're interested. You got them captured. You thought about it. You got to do something that's a little bit out there. You can't do that if you're not monitoring things. So one thing I love to do, I did this last year, it worked pretty well, is which stocks fell the most in the last 6 months? And is there one of those I think might be a good recovery? So I did that with Meta and Uber, and those both worked pretty well. I got scared and so kind of thinking it doubled a little fast there. Plus, I thought its PE should be above 20, and it's above 20 again. So I'm like, I'm out. But that's an interesting approach, right? Just find all those stocks that fell more than 50% and just see if there's one of them you think might have a recovery story. But that's the kind of things I would do. But, get into this kind of stuff. And reason I emphasize GMO is they do a lot of this stuff as well. So it gives you some ideas that are a little off the cuff. All right. All right. Any questions on any of that? Any of y'all have a dashboard? Not in your car? but on Bloomberg. So build a dashboard. If you want to know how to do it, let me come see me. All right, that's it for me.
Thank you so much, Professor. All right, we definitely want to make note that the FSC is open to everyone. So you guys can come down there whenever it's open and make use of those resources, all those Bloomberg machines. Seriously, crazy powerful tool. And coinciding with that, classes and sectors. So like you said, this is a week or two out from now. And hopefully Monday, maybe the Monday after. But this goes back to what I was saying about attendance versus attention. Coming here is a great way to get your attendance in, but going to those sectors, those classes, is a great way to actually improve yourself, improve your skills, and prepare for your career. All right, so here's a little bit more on the classes. I'm pretty sure most of you guys know what's up. Those are still coming out next Monday or the Monday after. But most of those are in the FSC. And again, you can go down there for anything. Doesn't have to be a class. You just want to study. It's a great environment. Awesome. So here's the semester outlook. And the highlighted are our new dates. The investor hour is still a go. We had a couple dropouts. I believe right now it's just Victory Capital, but they're sending the president of investments. So it's still a big deal. He's gonna be here in person, right, Anna? Yes. So we got to speak with him on the phone. He was super excited, super hands-on, super smart, just from that phone call. So definitely head out to that. Next Tuesday is our Top Golf with BSC. That's gonna be a ton of fun. I think that's at 2 p.m. So kind of in the middle of the day. Hope we see you guys out there. Cool. And then SGA Field Day. That's that sports thing. We're going to try to win this year. Have we ever done it before? I don't think so, but we're going to try to win this year. It's me, myself. I'm going to be out there. So sweet. Awesome. So this is the sign up for the investor hour. So this is going to be with Victory Capital, President of Investments, Nikhil. Feel free to sign that so we can get a head count of everybody. I believe the room holds 70. So we're going to try to make sure to market this and really get it out to all finance students. So, get your place now. I'll give you guys a couple seconds. The QR code working? Yes. Okay, cool. Phones. Sweet. And if you guys missed any QR codes throughout the presentation, whether it's the sign in or whatever, I'll go back to those for you. Sweet. And then do not forget about the Market Watch competition. Here pretty soon, we're going to start putting up the leaderboards. I haven't looked at it too much, but it's never too late to sign up. I mean, you can go all in on any sort of gamble you like, and you have a chance to win $100. So that's an easy one. Oh yeah, and the password is lowercase invest. Lowercase invest. All right, up next, I'm gonna have Arnis here. He's gonna tell you guys a little bit about the HSI Career Expo.
All right. So I know what you guys are thinking. Oh, another career fair. Let me just tune it out and, this isn't important. But I'm here to tell you why this one's going to be different from all the others, right? So this one is, unlike most career fairs that we have here, right? Like the ones we had last week, I believe, if I'm getting my dates right. Where it's just companies that are already working with UTSA and just the ones in the region and more local companies, right? So this Career Expo is going to be different because it's essentially a national program. So it's with all the Hispanic serving institutions within the United States. And there are 14 of them that are going to be attending this Career Expo, right? So this is 14 colleges, universities across the entire United States. There's a couple from California, Florida, up in Chicago. So all of them and their connections are essentially coming together and merging together to bring over 250 companies. So last I pulled it, which was like this morning, was 274 companies. And I looked through the list on Handshake. Some of the ones that I thought you guys might find interesting, the SEC is actually recruiting, and they're going to be at this event, right? The Federal Reserve, I believe the Federal Reserve Bank of Dallas is going to be there, right? HSBC, which is a huge investing bank, is going to be there. Citibank, which is another big bank, is going to be there. And there's like 270 more. And they're adding new ones. Just a couple days ago, they added Netflix. Netflix is going to be there. So this is a chance for us, for you guys really, to connect with companies that don't usually service UTSA, right? So companies that don't usually come out to UTSA, you get a chance to direct or interact with them one-on-one and in group sessions, right? So it's for everyone. And on top of that, as an incentive to get you guys to go, we made it so if you guys attend this, you gain credit for one of the social credits that you have for the investment side that you guys have to do. So I know you guys are thinking, this is a great opportunity. I'm going to attend anyway. But you know what, like I'm kind of on the fence, and what does it do for the investment society? How can it benefit the investment society if I show up? Well, that's a great question. And what we're doing is this is run through the College Career Center. So they're having a competition with all the student orgs, right? And whoever can get the most attendance, right, the org has a chance to win money. So if all of you guys show up and sign up for this event, then there's a good chance that we can win some money that we can use to give back to you guys for any event that we would want to hold in the future. If it's any academic event, then we could use these funds to help support it. So sign up, guys, for you to be entered in the opportunity for us to win. You have to sign up for 2 workshops and sign up and attend 2 workshops, and that's it, right? So it's essentially like 1 hour of your time next Friday, I believe. Yes, next Friday. And it's a great opportunity. There's a bunch of companies there. Hope to see a bunch of you guys sign up.
All right, shout out to Arnis for bringing us stuff that really matters. Like I said, getting involved and getting active in trying to change the trajectory of your career. This is an amazing opportunity. Thank you, Arnis. This is the opportunities we're looking for. All right. And I heard there's a competition, and we're the investment society, so we're going to try to win them. So everybody needs to sign up and get active in them. All right. Next up, we have the society merch. We're going to sell these after. If you guys want to buy one right now, we're about to do the raffle, right now? Yes, we'll do the raffle right now. So if you guys are wearing an investment society shirt or polo, you guys are entered to win a $20 Starbucks gift card. I'm not seeing a lot. I know we have 1, 2, right? See, okay. You guys don't count. So it's gonna be a coin flip. You guys had a chance at $20. It's on a coin flip right now. So we'll do a coin flip. We'll have Siri. We'll ask Siri. Say, Siri, flip a coin. Anybody? All right, Alina, you're gonna be heads. You're gonna be tails. Okay. You just say Siri, flip a coin. Okay, this works. What? The winner is heads. Alina, back-to-back winners. She won the general pot last week and the gift card this week. Talk about luck. All right. Congratulations. I'm sure we'll do this again if you guys want to buy a t-shirt. Hopefully it's not a coin flip next time, but we'll see. Okay, gotcha. Spring grads, make sure to scan this. This is going to be for the schools, and if we're going to have another banquet this year, last semester's banquet was awesome. Great time, so make sure to scan that. All right, and we are preparing the winners for the general gift card. Make sure to stay connected with us, whether it's LinkedIn, Instagram. I love following the Instagram. There's a bunch of posts, keeps me updated. So honestly, that's how I learn about a lot of the stuff that we're doing anyway. So, all right, all right, guys, if you guys want to do a drum roll for the winner of the $25 gift card.
It's gonna be Diego Diaz Gonzalez.
Congratulations, Diego. Afterwards. That's for now. Okay. We're rolling it again, another drum roll afterwards. Or no? Now. Okay.
Juanilu and Aguilar.
Congratulations. Thanks for coming. See you guys next week.